Yeah, that's why I'm not shopping.
All right. We might kick off. Sorry to interrupt your conversations, having told you to talk on. We might kick off for our boardroom briefing on the federal budget with some year-end planning tips involved. Welcome to the third of our boardroom briefing series for this year. We were just saying it's nice for us to be able to have in-person meetings, but I also want to acknowledge that we do have a whole bunch of people online. They're listening through the microphones on the ceiling here. This session is being recorded. However, it's mostly me that they're wanting to hear. I feel sorry for them. But if you do have questions along the way, you're welcome to put them forward. Just be aware those questions will be part of the presentation. All right. And on a mechanical level, if you need a bathroom break, it is just out the door there and down the corridor to the left for the ladies, to the right for the gents. I'll give you some instructions about how to leave the premises when we finish up. By about 9 o'clock tonight, you'll probably be wanting to go home. By about 10 o'clock, you'll be desperate to go home. So no, it'll be long before that, long before that. All right, so we have the 2021 federal budget. Tonight, there is the budget in reply speech where the leader of the opposition gets to make their response to the federal budget. Oh, sorry, did I? The budget itself was sleep-inducing for the most part, which is kind of good. It means they're not messing around with too much, but that doesn't mean there isn't something they've been messing around with. So what we're going to be talking about, we'll go through changes that impact on individuals, changes that impact on businesses, changes that impact on superannuation, a little bit of tax planning, a little bit about, is there some other steps you should be doing, as we go forward in this somewhat modified COVID world. So that's the agenda. I'm hoping that we'll be able to finish up well and truly by around 6:30, be able to stay on for a drink, some more nibblies, and set you free so you can dive home and be ready for that budget in reply speech. Every year for the last 25 years, I've invited the team on budget night, which was Tuesday night. I say to the team, I'm going to put the federal treasurer up on the big screen. I'm going to sit down here. We'll get in some food, some takeaway, and we'll have a fantastic night. We'll throw rotten tomatoes at the federal treasurer when he says things we don't like. And I invite the entire team to come and join me. And every year for 25 years, I've had a fantastic candlelit dinner for one. Budget tragic. All that support that I get. I don't know. Okay. Right. So we just press the button. As with all budgets, there's always a but. They make all sorts of announcements on the Tuesday night, but what we'll get, when the button works, what we'll get through the houses, particularly what we'll get through the Senate. All right? Lots of announcements die before they actually get legislated. So what will actually get there, right? The details matter. Tax is all about detail, revenue measures, and with what start date. And be very super careful on start dates, because some of the things that were announced in last year's budget still haven't been legislated and still haven't come into effect. Some of the things they announced in last year's budget, they've said, go ahead and do it anyway. We're going to backdate the start date once we get the legislation through. So we have to advise clients to do things based on no law and a promise that they'll make the law work in due course. All right? So be aware of those risks, and details count. Okay, so always the proviso, and keep that in the back of your mind every time. So individuals, let's start there. Okay, sorry about the fine print, but the sad part is there's not a lot of excitement in this. So fine print, Limito, which is the low and middle income tax offset, which is code for $1,000 tax rebate if you are in a lower or middle income bracket, right? That was going to finish in the 2021 financial year that we're in right now. However, they've said they're going to do it for one more year, okay? Effectively, it's $1,000 tax break if you're on a low or middle income, right? The thresholds, they haven't changed. There is a paper on the thresholds that we can get to later on. It's worth up to $1,080. It shades out, and the higher your income goes, once you're up around $40,000, you don't get the full noise, and somewhere near $80,000 taxable income, you don't get anything, roughly, right? Okay, so that's nice. We'll have that $1,000 handout. You get that when you lodge your tax return. It's a refund. Big incentive to lodge your tax return. One of the sleeper issues that's getting a bit of press probably doesn't play so much to people in the room. The rules for residency are going to be simplified. Now, every time I've heard a federal treasurer of every colour for the last 25 years say we're doing simpler things, it has inevitably and always made my life more complex. Right? But they said they're going to simplify it. The residency rules for are you a resident for tax purposes don't relate to citizenship, don't relate to your passport. They relate to where are you? And if you're here, you start to look like you might be a resident. But there was a whole lot of very subjective tests that used to be in the Act. In fact, there were 4 tests in the old Act. They're still there today. And the 4 tests, only one of those 4 tests is actually an objective, hard, factual test. And that one test is, are you a federal public servant? Right? And if you're a federal public servant, you're a resident. Right? And if you're the spouse of a federal public servant, spouse or de facto, you're a resident. End of conversation. For everybody else, there were 3 tests and they were very subjective. What they've announced, but it's a press release in the budget papers, it's not law, what they've announced is there's going to be a new 183-day test, which says, have you been in Australia for 183 consecutive days? And if the answer is yes, you're probably going to be deemed to be a resident. Previously, that sort of test did apply, but there was a whole lot of ifs and buts and maybes and rebuttals and other issues that you had to surround it with. They're doing what's called a bright line test, or they've announced what they want to do is a bright line test. And the bright line is 183 days, we've got you. Wait and see whether the legislation actually says that.
Will they take into account the fact that some people like my daughter had to come back because of COVID?
So the how they take it into account is not yet clear. Right? Certainly there has been increased desire to get clarity on these rules because some people who were saying, I wasn't intending to stay, I wasn't going to stay in Australia, or I was going to leave, I have a permanent home abroad. They're saying, well, either I can't go abroad or I don't want to. Yep. So they've taken up permanent or semi-permanent digs in Australia. And now the tax office is saying, oh, you're here, we're going to tax your worldwide income because you've become an Australian tax resident. They're going, well, hang on a minute. So it is a requirement. You know, there is a need, not a requirement, there is a need for them to clarify these rules.
I have a question. The previous about being, are you a federal public servant?
Yep.
Yes, you are a resident.
Yep.
That is to cover public servants who have gone overseas to do a duty. So they are considered residents.
Yes.
So that means under this rule, they are not.
No, we haven't heard that they're going to repeal that part, right? And the idea that a bunch of foreign affairs public servants or defence public servants could go overseas and declare themselves non-resident, not pay tax and still get a lot of money from the Australian government. I don't think that's going to fly. Right? As they like to say, the pub test, that one's going to fail the pub test pretty quickly. If the Commonwealth government is paying the wage, they'll tax it. They'll find a way. Right. Self-education expenses. For many, many, many years, the first $250 you spent on your self-education to do a bachelor, master's degree type course you could not claim. That got watered down. It became horrendously complex as they put all sorts of rules in. Now they said, oh, bugger it. You can just claim whatever you can claim. You don't have to worry about excluding the first $250. Good, common sense, simple reform, that one. Most of our clients, it's not a big issue. This next point is a big issue. It's not actually so much to do with individuals, but it's a positive for many individuals. The exemption on gross pays below $450 per calendar month. So you have to pay 9.5% super at the moment on salaries, but if the gross pay is less than $450 in a calendar month, you don't have to. They have announced that first low threshold is going to be abolished. And so if you're paying somebody, you have to pay, the employer has to pay 9.5% from $1. Okay. So that's good for low income earners and casual workers. And it's being given what I heard described the other day as the pink wash, good for women who might have lower income and part-time jobs. It's always been a little unfair that people who have multiple jobs, if you had 3 jobs paying $400 a month, your total income per month would be $1,200, but because you got it from 3 different employers, you didn't get any super. Right? There's all sorts of issues around this. That's what they've announced. The start date for that is not clear. What they have said is it will not start until the financial year after the legislation gets royal assent. There is very little chance, and they have said it, there is very little chance that the legislation will go through before 30 June this year. So the 450 threshold it definitely still applies for the current financial year, may still apply for next financial year, but probably will be abolished in time for the following financial year for it to apply then. However, it depends on when it gets royal assent. Right? So be careful on start dates. That early slide. Right? So they've made the announcement. I've already had somebody phone me up and say, do I have to change all of my payroll in my payroll software to do this? And I said, not yet, you don't. Just wait. And so if you want to, you can. But yeah. Okay, so we'll get on that one. There is a raft of standard form thresholds and rates that get indexed every year. They're all being indexed. I could fill a slide with things that would absolutely bore you to tears. If you want the list, I'm happy to hand them around. They're here, but it's pretty boring stuff. Just going to say a whole lot of little rates and thresholds that get indexed. That's fine. The other one that I did put in for particularly our Canberra-based clients, if you are in the ADF and you're one of the personnel set on Operation Paladin, you get an income tax exemption for your service whilst on duty on Operation Paladin. Cool, happy to support those. Okay, that's it. So tax thresholds, look at the middle column here. You can do anything. It's boring. Right? A nice boring budget. They didn't change the tax thresholds and the tax rates. So the current financial year rates, which is in black, no change. In blue, there are changes proposed for where it will go on 1 July 2024. That legislation has been put through. It's still there. There was pressure that they should bring it forward. They haven't done that. So at the moment, we have the black law not changed. So top tax bracket chops in once you earn more than $180,000. In a few years' time, that's to go to $200,000. And their announcement is that from 1 July 2024, a huge portion of people will be paying a flat 30% rate. But at the moment, most of the people are paying a combination of 32 and 37. So the cynic in you would say 1 July 2024, that's at least one federal election away. Watch and see this not happen or get modified. Anything the government proposes something that's going to happen in 5 years' time, you know that's at least an election away, if not 2 elections away, and you go, okay, whatever. Live in Canberra long enough, you do get a bit cynical. Okay. So what did it all mean? Did you have to do something consequent on the federal budget from an income tax point of view? I did try to keep my eyes open, really. Okay. So let's talk about business. What's it done for business? So the key item is the instant asset write-off has been extended beyond next financial year to the one after as well. Okay? So instant asset write-off, there is no dollar threshold anymore. If you can afford to buy $1 billion piece of equipment, you can claim an instant tax deduction for that $1 billion piece of equipment. Right? Good on you. None of our clients have that sort of size, but it's infinite. Previously, there was all sorts of lower caps that had to be under 10,000 or 30,000 or 50,000. There's no upper cap on it. They want you to stimulate, they want business to stimulate the economy by going out and investing and buying things. Good bang for the buck out of that, hopefully. There is one trick to it. There's actually a number of tricks to it, but one that I will quickly note. I've already had a number of clients, and when this was first announced, we had a number of clients say, bring on the Ferrari, instant tax deduction, company-owned Ferrari. Right? No. If it is a car as defined, the car has to be below the depreciation cost threshold, which is about $58,000. If you spend more than that on the car, if the purchase price is more than that, you don't get an instant write-off for all the rest, but you do pay fringe benefits tax on all the rest. All right? So cars, you can't just go out and buy the Ferrari or the Merc. The Winnebago, somebody suggested to me, they wanted that to be an instant asset write-off on a car. No, the threshold is what the threshold is for everything except cars. Okay. The other catch to this is it has to be first used or installed ready for use in order to claim the tax deduction. Merely having it on order is not enough. All right. And when it comes to cars at the moment, if they haven't got stock in the country, it's probably 4 to 6 months before it will turn up. So right now, if you're thinking, good, I'll go and buy my new tradies ute, or I'll go and replace the runabout, right? And I'll spend less than the 57,000 that Rob mentioned. That's cool, but you might find you're on a 6-month order list to get delivery of it, which means your tax deduction won't be in this financial year. Even if you pay the deposit or pay it in full today, your tax deduction won't be until you take delivery of the vehicle or install the piece of equipment or whatever it might be. Okay, so that's proving to be a bit of a challenge. One of our team members was looking to buy a new car back in April and went into Toyota and said, this is what we want, we'll have one of those. And they said, yes, delivery will be in October. That was the earliest it could be arranged. Very popular make of car. And one of our clients phoned me up just before Christmas and said, Rob, I'm sitting in the tractor factory, he's a farmer. He said, I'm sitting in the tractor dealership. There are 3 tractors of the sort that I want in the country. There are 3 people in the queue behind me in this dealership. Can I buy it now? It's a $130,000 tractor. Right. He's a very, very good farmer. He needed the tax deduction. He said, if I don't buy it now, sitting in front of the salesman, if I don't buy it now, the next shipment won't arrive until September. So at Christmas, he was already putting in his order to make sure he got one of the ones that was on the ground, because it was 10 months, 9 months before he'd be able to get another one. So getting supply at the moment is quite a challenge. So cars, getting them, keep it below the luxury tax threshold. And to get the write-off, it's not when you pay the deposit or when you pay the full price, it's when it has been installed and is ready for use. Okay. If you're under $50 million in turnover, new and second-hand assets. Cool. Okay. So, and just out of that, the practical effect of that is for many clients, paying tax, business clients, paying tax has become completely optional. You can go and pay the tax office, or you can go and buy plant and equipment. Of course, that does rely on the assumption that you actually need the plant and equipment. No sense buying it if you don't need it. That's just a waste of effort. Okay. The other thing they announced is the loss carryback measures are going to be extended for 1 extra year. All right? So what happens here is if you made a loss this year, but you had a profit that you paid tax on last year, you can actually take this year's loss, see how much tax you would have paid on that amount last year, whack it in the return and get a refund of tax that you paid in a previous year. Prior to this event, losses always had to be carried forward, and if you paid tax in the previous year, that was tough. Right? This year, you can actually do time travel, right? And they had said that would be available for 19, 20, 21, and 22. Now they've added 23 financial year. Okay. Our reality in here, most of our clients are actually still trading very profitably, and we don't have clients that are doing this at present, by and large, but we will see as we go through this year-end season as to whether that changes at all. There may well be some exceptions, but for the most part, we're actually seeing clients that are doing very well. Canberra economy, Canberra is a great place to be in business when there's a crisis. So you had to have made a profit, and then you made a loss, and that's now been extended past 22 into financial year 23. Right? Your turnover has to be under $5 billion. There are a whole collection of ifs, buts, and maybes and traps in this piece of the legislation. Do seek our advice if you want to play with it. And one of the traps is what happens if your franking credits run out. So if you've made a profit in the previous year and you've paid it out as a dividend, you probably can't go back and make a change now. Come and talk to us if you want to play in this space. Okay. That one's a bit funny, playing with timing. Hopefully you can get your head around it. If you have questions, come and talk to us. Okay, so business announcements. I put this in under the individual slide, but as I indicated then, it's actually a major business issue. And the business issue is that businesses are going to have to change their payroll systems to make sure that if you're under $450 gross in a fortnight, you do still put superannuation on those calculations. So that is a payroll issue. Systems, right? And many business systems will need that to be adjusted or changed. Okay, but not yet, because we don't know the start date. Also for business, certain grants, particularly fire and flood, fire from last financial year, floods from last financial year, fire and flood grants, certain grants have been exempted from income tax, and in some areas, that's been announced for some time. They re-announced it in the budget. And there's technical amendments to a whole pile of really small things, including microbreweries have got an exemption from some of the liquor taxes, some of the research and development stuff they're playing around with, a whole lot of very narrowly focused things. They're adjusting thresholds and putting a few dollars here and there into those sorts of things. I haven't gone to town on those because A, they're boring as anything, and B, it's a very, very limited and mostly not applicable to the vast bulk of our clients, but there may well be some. In our budget. Yeah, sure.
For those who have investments in, say, medical research or supply companies, if there's a significant impact on them, that'll obviously have implications for shareholders.
Correct. Yes, it may go upstream to shareholders at that point. Yeah.
Yes. So do you have any comments on?
Not yet, because until we see detail, always dangerous to comment on press releases, even though we sometimes do, but that stuff haven't really focused in on. You know. Some of the detail is the federal budget briefing that we've sent out from the firm, runs to about 25 pages. It does cover off on some of the more esoteric items. So you have got that available, and I think that's downloadable from our website. It will be shortly. So business, company tax rates, no new changes. Right, again, very boring evening. Boring is good when it comes to having to be an advisor on tax issues after a budget. Right? They did say, oh, we're still dropping tax rates. These drops in tax rates were announced 5 years ago. So the company tax rate for what's called a base rate entity, which is, there's a whole lot of conditions and ifs and buts and maybes, but small business that is actively trading, effectively over time is dropping from 30% down 27, 26, 25% over the next couple of years, financial years. Okay. If you're not in one of those special categories or in the special category of a base rate entity, everything else pays a flat 30% for this purpose. So they have said, we're still looking after companies, looking after businesses and yada, yada, yada. It's announcements made 3 and 4 and 5 budgets ago. It's not actually new news. Okay. So good. There is a bit of sleight of hand here. I'm going to give you the bad news in here. If you made a whole pile of profit 5 years ago, taxed at 30%, and you let it sit in your company for the last 5 years, that profit that you made got taxed at 30% 5 years ago. If you pay it out now, or next year, or in financial year 2022, the credit you get will be at 25%, not 30%. So that profit that got taxed at 30% will now be taxed as a dividend to you with only a 25% credit attaching to it. Effectively, they get the 5% twice. So anybody who has large amounts of retained earnings, recognise that you've already lost the opportunity to do anything on the first 2.5%. You'll soon lose the opportunity on the first 4%. All right? It is what it is. Every client I've looked at on this has said, for 1%, I'm not going to change anything. I'm not going to do anything. And because it's 1% per year over the 5 years, it is what it is. The clients with really big retained earnings, and I've got one client that's sitting there with $4 or $5, $6 million in retained earnings. The idea of paying that out to save 5% but trigger an enormous amount of tax today to do so wasn't worth it. Okay, but not new. It's been there for a while. I've left this slide in. If you came to last year's event, this is actually the same slide from last year. Mainly putting it in because all the things they announced last year on this were to start now. Right? So a lot of these things are only starting now, even though they're announced in last year's budget. Right? So you can get more electronic devices per employee per FBT year. The FBT year runs on 31 March renewals. Right? Retraining and reskilling people because they're all going to lose their job in the COVID environment. So they said this is going to be great. Well, right now there's a lot of people who are looking for people to get to do work. So that's a nice announcement, but I don't think it's actually going to amount to much. And there's some reduction in some record keeping rules. There's been a bit of press saying FBT should just be abolished. All the accountants are going, hallelujah, it should just be abolished because it's a pain in the neck to deal with. Right? I don't think the government will abolish it anytime soon. The start dates on these are very different depending on what particular measure you're looking at. So for our trading businesses, be aware, keep writing to your local members, all useless ones of them, saying to them, just get rid of FBT, it's a pain in the neck, save your accounting fees. We would be delighted for it to go.
Does that include the logbooks for cars?
I just can't see them abolishing it. And when they say they want to abolish FBT, that's the headline, and that's a great headline. The subtext in the fine print underneath is, instead of making the employer pay the fringe benefits tax on it, just add it as an additional allowance on the employee pay summary. Right? There was something I was reading the other day, I don't know how accurate it is. There's only 3 countries in the world that tax the employer on fringe benefits: Australia, New Zealand, and India. All the other countries simply added on as an additional allowance on the payment summary and tax the individual employee on it. Are we smart, or are we just out of step with everybody else in the world? And some other announcements from last year, just as little reminders. The definition of small business is being modified, and for some limited purposes, a small business might be at a $50 million turnover. For other purposes, it's still a $10 million test. And for other purposes, in fact, there's a $2 million test. All right? So be careful about when somebody says, am I a small business, which definition and for what purposes is being used. All right? Car parking, trading, stock and startup expenses are 3 where they've given a bit more room for people to play with. It's not actually worth a hell of a lot. It's kind of cute, but really. R&D changes for people doing research and development. Again, announced last year, start date this year. Apprentice wage subsidies, I'm not actually sure where that's got up to. Everybody's trying to find people to become apprentices. Certain foreign companies in Australia to become Australian tax residents. That legislation has gone through, but it's a mess. This is something that has been announced 3 or 4 budgets ago. I've put it in purple because there's not a new announcement, but it is just about to actually have the rubber hit the road, unless something happens. Right? So the SGC rate is going to, by law, increase from 9.5% to 10% from 1 July. That is currently black and white law. The current government is being lobbied by various organisations to say we shouldn't be giving an across the board everybody 0.5% pay rise on 1 July in the middle of a pandemic. There's a whole bunch of other people saying absolutely that's precisely what we should be doing, and putting it into super. So all of these guys are busy lobbying the government to say, don't change this or else we're going to hit the press and really make life miserable for you. All right? That's happening. At the moment, the government can sit back and do absolutely nothing, and that's what will happen on 1 July. So for the employers online and in the room, be aware that everybody's getting a 0.5% pay rise on 1 July. It's just they're not going directly into their pocket. It's going into their retirement savings instead. Okay, so something that you will have to change your payroll systems for. So what did it all mean for businesses? The bottom line here, there wasn't much that was new. What there was kind of nice and kind of cute. There were no revenue measures of any substance. Revenue measures means new taxes. There really wasn't any new taxes of any substance. And some of you in the room would remember a previous treasurer, and I can't actually remember whether it was Costello or Keating, but one of them strolled up to the dispatch box and said, in tonight's budget, no new taxes, no increased taxes. This was one of those budgets. Quite strange. What they really want you to do, if you are in business, is go and do the instant asset write-off. Go and spend big on plant and equipment. Go and buy it and install it and stimulate the economy, mostly China's economy, because that's where it gets made, but let's not go into that. And if you see a little red dot appear on my chest here, duck. Do not use a lease if you're buying the plant and equipment, because if you have leased it, the leasing company owns it, you don't. They get the tax deduction, you don't. You can use a chattel's mortgage, you can use a loan, you can pay cash, right? Just be careful of not soaking up all of your cash when you need it for fluctuations and pandemics and short notice shutdowns that may still happen. But spend big on plant and equipment. That's what they want you to do, and they've given us an extra year to do it in. Fantastic. Right. So businesses, nice boring budgets. Budgets that are boring are good because you don't have to try and adjust everything. Okay. Superannuation. The heading is almost no changes to super. And we all go, oh, phew. They mess around with superannuation far too often, far too much. Right? No real changes for SMSFs. Right? I know we've got a number of self-managed super funds in the room. We look after about 160 self-managed super funds in our firm. We're not the biggest in Canberra on that, but we're way bigger than the smallest. Right? No changes to SMSFs. Okay, relax. They're complex enough as it is. Okay. So they did make some subtle changes, but nothing headline, nothing major. Right? First of all, the work test, they have said they will abolish the work test for 67 to 74-year-olds for the purpose of getting non-concessional contributions, after-tax money in, or for getting salary sacrifice money in, right? But you do still have to have the work test passed if you want to make personal deductible contributions. This is a bit of a mess. And again, it's making some more complexity in this area. By and large, it's a good thing, but more tests, more exceptions and more rules, we have to just manage through that. And the start date is kicked down the road again. Okay.
Excuse me. Still, work test required, still required for personal deductibles. Is that $25,000? Is that the one?
So if you want to make a personal tax deductible contribution,
Which is up to 25,000.
which is up to 25,000, yep.
You still need a work
You
test.
still have the work test if you're over age 67 or 67 and above, to be accurate. Okay. So some more complexity in there. Okay. Downsizers, you would have heard, or some of you may be aware, that if you sell your home and you've lived in it for the correct period of time and you get some cash available, you can stick that cash into super. Previously, you had to be 65 and above to achieve that. They've now said, actually, you only have to be 60 and above to achieve that. But when I say now, again, start date 1 July 2022. So can't quite do it yet if you're between 60 and 65. Again, if you want to go down that path, seek advice. There are traps and issues and conditions and hurdles you have to tick before you can achieve it. The super guarantee rate, I've already mentioned, goes from 9.5% to 10% on 1 July. That is law, as I keep emphasising, but there is pressure for them to undo it or to defer it or to mess around with it. We will see what happens. And the super guarantee will be applying to $450 per month. So basically everybody on payroll gets super, gets SGC, but the start date for that kicked down the road. Mercifully, that's actually all the announcements on super there is. Right? One slide with 4 big pink dot points on it. I've done presentations in previous budgets where 2/3 of my slides were on superannuation changes. Right? This is kind of cool. We got to the end of budget night and I was nearly asleep. Right. There are some other things that have automatically happened, right, that they haven't had to announce on budget night. In financial year 2021, where we are right now, going to finish in about 6 weeks' time, if you want to claim a tax deductible contribution, or if your employer is putting a tax deductible contribution away for you, it is $25,000. Right? That's the maximum tax deductible amount. There is no other tests, or sorry, there's no other age or other criteria in terms of the dollar limit. Everybody gets the same dollar limit. With one exception, and that is if you didn't use up all of your contributions in the past couple of years, you may be able to roll unused limits into this year. Okay, putting that to one side. That $25,000 is indexed, but it's only indexed in $2,500 increments, so it can take 3 or 4 or 5 years for it to catch up. It has now caught up. So 3 or 4 or 5 years after we had the $25,000 limit, it's been there for quite some time, the limit from 1 July, so next financial year, goes to $27,500. Right? So just a little bit more room. Okay? So you can put a little more tax deductibility into your super fund as an employer, as a personal deductible contribution, subject to all the other tests, hurdles, thresholds, and conditions that are required to be met.
It used to be 35 before. Remember?
It was 35 and 50, and I remember when it was 100. That just makes me old. After-tax contributions, and again, this is not new. This is an indexed process that happens automatically. It was announced 5 years ago, the 5 years, and it wasn't happen every 5 years. It just happens that it's taken that long for the indexation to happen. So for financial year 2021, the year we're in right now, going to finish in 6 weeks' time, $100,000 of non-concessional money, which means money you had under the bed, you've already paid tax on, you're going to put it into the super fund. The cap was 100,000, or subject to a whole lot of conditions, you could grab this year's 100,000 and the next 2 years worth and put in 300,000 in one go, subject to a whole lot of conditions. And your total balance, if you exceeded $1.6 million, you're done. That's the rules at the moment. Cross 1 July in 6 weeks' time, for 2022 financial year, the 100 becomes 110,000, the 300 becomes 330,000, and the cap becomes 1.7. Okay. There is a whole lot of complexity about how the 1.6 moves to the 1.7. If you happen to be getting close to that limit or you're just over it, get advice on how that's going to impact you. All right. There are issues, conditions, problems around managing that. It's complex. I'm not going to go into the complexity tonight because I would bore you rigid if I haven't already succeeded in doing so. Yes.
So with that limit, it's 300,000 or 330,000 or whatever.
Yep.
So when you mentioned earlier about if you downsize and sell your house, say you sell it for $10 and you only want to spend 20 cents on a new place.
Yep.
So you've got 800.
Yep.
Does that count as? I mean, how is that counted?
Grant, I think the downsizer is not counted towards that threshold.
Correct. So the downsizing contribution is separate to these rules and it's separate to the threshold as well. So it doesn't count as a non-concessional. It doesn't count towards the 1.7, 1.6. The $110,000 limit is its own limit. So if you have met all the other conditions and you can make a non-concessional contribution, you can potentially put in $110,000 on the 1st of July and $300,000 from the downsizer contribution. And if you want to bring forward 3 years, you can put $630,000, and that's per couple. So 2 of you are in the house that's sold, you put $300,000 each, and then $330,000 each, provided you have the right balance of your self-managed.
And there are some other
Does it
eligibility.
have to be a self-managed super?
No, any super fund.
There are some other eligibility criteria, so just make sure you get advice before proceeding. Okay. So good stuff happening in that area, and it opens up some options that previously were a bit closed. The interesting thing is that we are actually seeing just a few people make use of that now. Previously, what happened was people would downsize, but they would up luxury, and they'd free up no cash from the process. Right? And the other silly part about it is you don't actually have to use the money from the sale of the house to put into the super. Right? You could have that money sitting under the bed as long as you've sold the house and ticked all the other eligibility criteria. What you do with the sale of the house doesn't matter. If you've got the money under the bed, you can still tip it in. So it didn't have to be a direct transfer. There is, however, some really tight timing rules. All right? You can't sell the house 6 months ago and then think, oh, maybe I should get some advice and do that. You will be out of time. All right? So if this is a strategy that you're excited to do, seek our advice and get the advice to get it right and to ensure you're eligible. So believe it or not, that was the budget in very long at all, right? 40 minutes and we covered the budget. It was not terribly exciting, and not terribly exciting in these terms is a good thing, right? Especially when you get to my age and you've seen lots and lots of budgets come and go, and all the ones that generate extra work, and here, done with that. So good. What we always do at this point in time is we are 6 or 8 weeks from the end of the financial year. The end of the financial year is a great time to make sure that you're in good shape for the next financial year. So what we like to say is the best tax planning is not done with 6 weeks to go before the end of the financial year. That's when you might do some fine tuning, and often that's necessary. But this is a good time to actually set your budget, set your expectations for what to do for the next full financial year and get it right for the whole financial year. Okay? Bit of planning, bit of forward looking. So doing things for tax purposes, always somewhat smart, but make sensible decisions. All right? Don't let the tax tail wag the commercial dog. All right? It's a mantra that I've had for many, many years, learned it from somebody I don't know anymore, but I learned it from somewhere. But don't let the tax tail wag the commercial dog. If there is an investment or a business idea or a suggestion that is good, tax might make it slightly less good. But if there is a suggestion or a supposed investment or something that is an absolute dog, tax will not make an absolute dog a good investment. I've never seen tax make a bad investment good. I have seen tax make a good investment slightly less good. And sometimes if you get it wrong, it can make a good investment go bad. That's not very frequent, but never ever will tax make a bad investment a good one. Okay, so in terms of tax planning, whether you're in business or individuals, delaying the income into next tax year when the rates might go down, or into 2024 when rates might go down, delaying income, at least it means you don't have to pay the tax on it until 12 months later than if you put it through now. Simple stuff. Tax deferred is tax not paid. So delaying when you pay the dividends out of your company, of course, means you'll get slightly less credit this time around. Delaying when you pay yourself a bonus, if you're going to give yourself a bonus in your company or your business. Delaying the interest income, term deposits. I've got a whole pile of clients who had their term deposits mature on the 28th of June. That's just nuts. Have them mature on the 2nd of July, throw the interest into next financial year.
All $10 worth of
All $10 worth in current term deposits, absolutely. Right. Don't invoice. If you don't have the invoices sent out, you don't have the income. If you don't have the income, you don't have the pay, you don't have the tax. It's a pretty stupid idea. As one of my clients who retired very happily many years ago, very wealthily, said, if I've got a client who's busting their ass to pay me for my services, I'm going to take their money because it might not be there next month when I want to get it on my timing. So don't invoice. It's actually a pretty dumb idea. Exchange contracts after June on CGT events. If you are thinking of selling your house, selling any other shares, selling capital gains tax assets, the date of exchange of contracts determines which tax year it falls into. For property, it is not the date of settlement, it is the date of exchange. All right? One of my barristers got that wrong, and he specialises in property law. So I don't need to worry about that, Rob. I didn't settle on it until July. I said, yes, you do. And you exchanged on it in June. And he thought for a moment, and then I won't say what he said next because this is polite company, but it wasn't pleasant. His fault. So date of exchange for gains tax. So on the income side, it's throw it down the road. On the expenditure side, it's bring it forward. So bring forward deductions for businesses. Buy your plant and equipment, get it installed, ready for use, instant asset write-off. Love it. Great stuff. Pay your June quarter super before 30 June. Superannuation is a tax deduction when the fund receives payment from you. So it's not enough to say, I've accrued it in the accounts, I've put it aside and I'll pay the bill next month. If you don't pay the super bill till next month, it is not tax deductible until next month, right? Even though you've put it through your system and you've accrued it. So prior to 30 June, we tell all of our clients, have a look at your payroll accruals and super, actually initiate the payment to the super fund before 30 June. Okay, so the fund has got the money before 30 June. Okay? 30 June this year is a Wednesday. I have a client who does their payrolls on Tuesday. Right? They're going to prepay the super the week before that based on their best guess, because otherwise their tax deduction wouldn't be until the following period. Their superannuation is $60,000 a month. Right? Payroll of $600,000 per month. Okay? That's a big tax deduction to have thrown into the next financial year. Okay? So pay your super and pay it before 30 June. Usual story, if you think you've got bad debts, write them off in June. Keep documentary evidence as to why you're writing them off. Right? And it's not sufficient to say, oh, I'll write it off in June and then I'll reinstate it in July. That's called offence. You go to jail for that sort of stuff. Right? You've got to have said, yeah, I'm giving up on it. I've been chasing it for 18 months. It's dead. I can't get the money, whatever. If you have old stock and equipment, some of our clients online might have old stuff lying around. Write it off, we can claim it as a tax deduction, throw it out, get it to the garbage bin. But if you still have it on the shelves gathering dust, you can't claim it as a tax deduction yet. Fringe benefits, tax concessions, buying new laptops, mobile phones, fantastic. And for small business clients who satisfy the SBE test, one of the SBE tests, prepaying up to 12 months of business expenses, so prepay some rent, prepay some interest, but not trading stock. Generates tax deductions now. So effectively what you're doing with that is you're grabbing next year's tax deduction and dragging it into this year and claiming it now. Fantastic. Worry about next year. Bringing forward deductions for individuals. Everybody gets a little more expensive. Self-education expenses, the $250 we may or may not get fixed through for this financial year. Your membership fees, professional library subscriptions, make donations before 30 June. Choose your favourite charity and give them a bonus. Right? Instant, simple tax deduction. Prepaying your income protection insurance premiums or interest on your rental property. Right? Options in there. And you may, if your employer has put some superannuation away for you, or if you otherwise satisfy certain conditions, you may be able to top it up to $25,000 as a personal tax deductible super contribution. That is relatively new. You've only been able to do that for a couple of tax years. Prior to that, many people could not do a personal deductible contribution if they had employment income. Now the door is open that you can have your employer do some and you can top it up personally. Again, seek advice, get advice as to what the right mix and the right blend is and how to manage that, because there are obviously tips and hurdles on how to do it. And it all has to be well and truly done before 30 June. All right? Don't come in on the Wednesday the 30th of June. It will be too late. I do keep a 12 gauge in reception for anybody who wants to do that. Right? We'll bury you in the basement. It won't be a problem. Trust distributions. If you happen to have a family trust, you can make a distribution to children under age 18 who are otherwise fit and healthy of a princely $416 per annum tax-free. After that, they go straight to the top tax bracket. You did not have children for tax purposes, just sort of putting it out there. Distribution minutes. If you have a trust, we usually send you some notes saying, here's a meeting that you held in June, and here's what you're proposing to do with your trust profits. We'll send that out, and there is some more evidence about how to do that if you're trying to stream particular kinds of income through your trust, particular kinds of beneficiaries. If you're in that space, hopefully you're talking to us so we can get it right. So we work through all of those. That slide is the same slide that I've been using now for about 10 years. It's still there. That $416 has been there since 1970 something. They have not changed that number in nearly 50 years. So, yeah. Somebody actually told me the start date for that. I think it was 1974, 1976 or something. I don't know if anybody else did the history of it, but it's been the same number for 50 years. It's one of the few numbers I can remember. Okay, so tax planning. Bring forward deductions into this year, kick income into a subsequent financial year if it is smart and sensible and commercial to do so. If it's not, don't let tax make you make bad decisions. Don't let the tax tail wag the commercial dog. We have 6 weeks or so to go to fine tune the outcome for the current financial year, take advantage of the concessions that are there. And we have a really good period now to set in place what is the plan for next financial year, whether that be a plan for superannuation funds, a plan for individuals, a plan for businesses. Knowing where you're going is always a good thing. So with that, consider how to avoid getting into the top tax bracket if you happen to be in that space. Staying below $180,000 is always a good idea. Negative gearing still works. Timing your income still works. If you're over 180,000, perhaps try and stay below 250, because once you go past 250,000, there's an extra tax on your super contributions. So seeing if you can avoid that, we can help you do that. Salary sacrificing superannuation up to your total $25,000. If you aren't doing salary sacrifice and you can afford it and otherwise appropriate and all those conditions, paying tax at 47% on salary, paying tax at 15% on super. This is not a hard decision. It's pretty obvious. Of course, if you're in the bottom tax bracket where you're paying nothing and you put money into super, why pay 15% instead of 0? That's also a bit of a daft decision. Okay, so going forward as I wind up, individuals, we can do tax planning, save you some money in there. Retirement planning, we have financial planning, limited license holders as well as fully licensed product providers here in our firm. Everill's financial planning, we can do the whole financial plan, fully licensed advice if necessary and that sort of stuff. As I mentioned, we look after a whole lot of self-managed super funds and we do all the advice around that. Rental property, including financing, and we now have a mortgage broking person in the office. So if you need to refinance your home mortgage, an investment property mortgage, business or commercial assets, even just car leases, we can arrange the finance for you through our office on those things. The correct structure for putting your investments in, that clients phone up today and say, hey, look, we're thinking of buying a property. Do I put it in my name or our joint names or the spouse's name or a trust? We can deal with all those sorts of things. That's very much run of the mill stuff, but if you get it wrong, it can be quite expensive. So what to do? Take home messages. Have a think about your instant asset write-offs. Talk to us if you need a valuation done or a mortgage broking or financial planning. Do some strategic planning, do your tax planning. We usually find that the conversation you have with us, you'll save many times that in terms of future pain, trouble, turmoil, or just straight out tax bills. So that's my sales pitch. I was never a great salesman. We can do all sorts of other help. And with that, question time. I'm finishing in less than an hour. Any questions?
I've got a question.
Yep, Lawrence.
So if you wanted to go and buy a real property to start a business like could you claim that as an instant asset write-off if it's under 50 million?
So the actual purchase of a capital gains tax asset as opposed to plant and equipment is different. Right? The instant asset write-off is limited to plant and equipment, not buildings, not land. So you could go and buy your hobby farm. First of all, because it's a hobby, it's not a business, and so you're not going to get any tax deductions. But if you bought your real farm, right, and then you said, okay, I need to buy a tractor, and I need to buy a combine harvester, and I need to buy this, that, and the other, all the plant and equipment items, go right ahead, you'll get a tax deduction for those, if it is truly a business. Of course, if you're just buying it today, you probably don't have enough income to use up all those losses, so you might want to do it in the next financial year anyhow. So playing with the time is always a critical exercise. All good on the superannuation side of things? I know there's some people in here who are excited on super.
My question's
Yep.
about UK inheritance tax.
Ah,
Yeah, that's the only, if we've got family in the UK
yes,
and we pass away, what happens?
yes. I'm glad you raised it. There are a whole pile of issues with the UK's inheritance taxes, especially if you are an ex-POM and you have come here more recently.
No, we're not.
And good, because recent by their definition is something like 25 years.
No, I'm Australian.
Yep. But if you're Australian, but you're one or more of your beneficiaries is living offshore, whether it be the UK or the USA or quite a few other countries around the world, there is often an inheritance tax or a gift tax that they pay on those inheritances. Right? And what we do to determine that is, I'm flat out keeping up with Australian tax law and a little bit of international.
Yeah.
What we do is we use our DFK worldwide connections. So I'd phone Neil in Southampton or a guy by the name of Grant in London. Right? I know those guys very well. Taking Neil, for example, he's in Southampton. I'd phone him up and say, we've got this client. They have beneficiaries who live in the United Kingdom and are probably still there. They're not dead yet because of COVID. They may inherit something from Australia, and we'd get their advice as to how to manage that, what the impact would be, whether you've got an issue or not. Okay, and brokering that conversation. Frequently, Neil and got Linda in the United Kingdom, the United States. We've got another guy over on the east coast of the United States that we can talk to that I know personally. And frequently they say, oh, why don't you do this? And I say, well, hang on a minute. If I do that, that's going to mess up things at the Australian end of things. So then we say, well, but we could do this at the Australian end of things. They go, no, 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 that's going to be terrible on the United States or UK side. And you have this sort of three-way conversation around what would work in the foreign jurisdiction, what would work in Australia, and you arrive at, oh, okay, if we do it this way, it might be the best outcome for all concerned. Okay? There is absolutely some traps with leaving assets to non-residents. All right? There's one section, which I was just playing with only yesterday. There's a section in the Tax Act which says, if you leave an asset, an Australian CGT asset, to a non-resident beneficiary, you will be deemed to have sold that asset on the day you died. All right? Now, the consequence of that is, and there's a whole lot of exceptions and ifs, buts and maybes, but the consequence of that sort of highlight is if you have an Australian share portfolio, for example, in your name, right, or real estate, doesn't matter. Actually, let's not do real estate, let's do shares just for the moment. Right? Yeah. Real estate's got a whole pile of other rules. So you've got a whole pile of shares in your name, and your will says 1/4 of the shares is going to go to, you know, a offshore person. Right? What actually happens is those shares, that 1/4, will be deemed to have been sold by you on the day you died at market value on the date you died, right? The offshore person gets the shares and they may have offshore tax to pay. But what happens is when the final return for you is lodged, what we call the expression, the last return of the living, we have to calculate all of these sales on something that was deemed to have happened, and all the capital gains tax arises. And that capital gains tax is payable by your estate.
If it's super, what if it's all in super?
If it's inside super, there's a different scenario again.
That's where it
Right,
is.
okay, so I'll come back to that. So if it was personally owned, but what then happens is you have a major inequity. The offshore person gets full value of the shares, but the onshore beneficiaries, the size of the estate now shrinks because the estate has to pay the tax bill and they're getting a lesser proportion. The offshore person hasn't paid the tax bill, the estate has, and what's left over for the rest of the onshore people has been reduced. And so potentially you have the situation where your onshore beneficiaries effectively pay tax on behalf of the offshore people, and it will not be equal unless you've taken that into account. Right? So quite a dangerous situation if you want things to be equal. If you want things to be unequal and you know what you're doing, fantastic, we can advise you through that. Superannuation, the payout from the super fund, again, we would need to just see what is happening in that. But the basic rule, if you have nominated an offshore person for that superannuation payout, there may be some tax depending on the components within the fund, but typically the fund would have to sell the shares first in order to make the payment to the offshore person. And if the fund sells those shares first, which is commonly the case, the fund will have to pay any tax that might be applicable. But again, there's a whole lot of ifs and buts and maybes. If the fund is in pension phase and those shares have been funding your pension, so long as the fund is wound up reasonably quickly, and there are rules around what reasonably quickly is, there may be no further tax at that point for the fund. All right. So the question you ask has a lot of layers to it.
What if they're dual nationality, Australian and British citizenship?
So Australian tax law at present, subject to whatever they might do on that budget announcement, does not care about citizenship.
So if he's got a British passport and an Australian.
Citizenship does not count under our residency rules at the moment. Right?
So it'd be best for me to sell all my shares.
So I'm not
Before I
making
die.
that statement yet. We need to have a look at what the detail is.
Probably would be. I'm not intending to die for another 20 years. but,
Yes.
um,
Now,
Yeah.
interestingly enough, citizenship is
Yeah.
a critical element if you hold a United States citizenship,
Right,
Right.
but not UK.
but not Australia. Right? But yes, if you've got a beneficiary who has United States citizenship, that's a whole different kettle of fish again.
Right.
Right?
So for you, he would be considered a UK citizen.
Pardon?
He would be a UK citizen for tax purposes.
Okay,
So he will be taxed on his worldwide income in the UK
right.
and any Australian sourced income in Australia. So his British life wouldn't matter. If you were to send him income from your estate, if that would be taxed to an Australian, it would be taxed here for him. So for super, it would go to your estate first and then to him, and it would be taxed because he's not a tax-free beneficiary for super purposes. So there would be a tax implication there for the super side, and then there's a separate tax implication if your personal holdings were to go to him as well. So they're two separate conversations.
Sounds ghastly.
That's why we're here.
Yeah, I mean, Grant's our super guru for tonight.
You'll have a lot of problems.
Perhaps I'll finish with this and then you can have informal conversations with us. Not to do with non-residents, but how to mess around with estate planning. I had a lovely couple, still clients to this day, came into me a few years ago. Some of you may have heard this story. Came into me a few years ago and they said, "Oh, Rob," and we're talking about doing their taxes. And they said, "Oh, Rob, we've also done our wills. It's really good. We've got the 3 kids. We've got the 3 houses. Each kid's getting one of the houses. And by the way, they're all worth the same amount of money. So it's all very good and it's fair. And we're very happy there." And I paused for a moment and I said, "So you know it's not going to be fair at all?" And I said, "Well, why not?" And I said, "Well, they may all be worth the same amount of market value, but one of them is going to be considerably less value to the beneficiary. You know, child number 3, who's getting house number 3, they're not getting full value at all." And mum and dad sort of said, "What? So, you know, they're all worth the same amount. How's this?" And I said, "Well, it's quite easy. Your main residence is tax-free so long as it's sold within 2 years of the date of death, by and large. So that main residence, and I forget the number now, let's say it was 600,000. So that $600,000 property sold within 2 years of the date of death, worth 600,000 to the beneficiary. Cool. House number 2, also worth $600,000. That's your coast house that you bought pre-1985, right? So it's a pre-CGT asset, okay? And a pre-CGT asset at the date of death is assigned market value at the date of death, okay? So even though they bought it for like $50,000 before 1985, right, all of the increase in value to $600,000 is tax-free at the date of death, and so long as the person who inherits it sells it pretty quickly, there probably won't be any further change in market value. So their $600,000 house is going to be worth $600,000. Sweet. 2. Child number 3 is getting your little rental property. Your little rental property you bought for $150,000. It's now worth $600,000. Okay, but it was bought post capital gains tax. So there's about $100,000 of tax to pay on that one. So that $600,000 property is actually only worth $500,000 to that beneficiary. And the mum and dad sat in my office and they went, oh, it's not going to be fair. They looked down at the floor and I'm going to have to read it. And there's this long pause and I let that sink in for a little while. And then after a few moments, the wife just looks sideways out of a corner of her eye to husband who's sitting next to her. And husband's sort of looks slightly sideways at the wife. Is that how it's going to work, Rob? I said, yes, that's exactly how it's going to work. It's not going to be fair. You think it's going to be fair, but it won't be. Child number 3 is not getting a good deal. And they looked up and they held hands and they said, that's fine. And with evil written on their heart and glee on their faces, they danced out the door.
Favourite.
And I do not know what child number 3 did to disturb them, but child number 3 is going to be got back on post-death. And they're delighted about it. And as they disappeared out the front door of my office, they turned around and said, Rob, you are never to advise our 3rd child. And off they went.
Oh my heavens.
Can I ask a question, please?
You can ask a question. You got one online.
I do. The start date for the new residency rules.
Yes. When the legislation goes through.
Yes.
Yeah.
Yes.
So
1 July after the legislation goes through.
So the first financial year after the legislation goes through is the last bit I've read on that, but you know that's as good as you get. So that's the opening slide which says take care of dates. That date is the most manufacturable of all. Yeah. All right.
That applies to a lot of the changes.
Yes. So with that, we'll call the formal proceedings to a close. I'll be around for a little while. Melissa's just walked in as one of the other directors. Grant is senior manager and super guru is up the back. We've also got Zin Tong listening in, one of our accountants. So please ask us questions if you have. Eat some more food, have another glass of wine. If you have to drive home, just be careful with that. To escape our physical premises, press the ground on the lift, go down to the ground floor, out of the lifts and just bend it slightly to the left. There is a little green button on the wall, not to be confused with the fire alarm. Don't press that one. And the doors will open and you'll be able to escape. Cool?
Thank you. Or if you're in the car park across the road, you can still go out.
Through level
Can you get to
1.
level 1?
I'm not sure that you can. Probably best to go down to
If you
ground.
can get to level 1, you just keep pressing the green buttons on the doors and it will let you out into the car.
All right. Thank you, ladies and gentlemen.
You've kind of.
Nice.